$500 billion. That's how much the five biggest AI companies on Earth have committed to spending this year. Not on products, not on people, on infrastructure, chips, cables, and concrete. And not a single one of them is profitable. The halftime numbers just came in. Let's check the scoreboard. 5 teams, 1 table. Here's where they stand at the halfway mark of 2026. OpenAI, $25 billion in annualized revenue, 900 million weekly users, valued at somewhere between 730 and 850 billion. They raised 110 billion in a single round in February. The biggest private funding round in history, by a factor of 3. Anthropic, 19 billion in annualized revenue, up from 1 billion 15 months ago, valued at 380 billion after a 30 billion raise. 8 of the Fortune 10 are paying customers. Google, Gemini just crossed 750 million monthly users. Their market share in AI chatbots went from 5.7% to over 21% in 12 months. And Alphabet is spending up to $185 billion on AI infrastructure this year. That number is larger than the GDP of most European countries. Meta, 2 next-generation models in the lab, codenamed Mango and Avocado. They poached 20 researchers from OpenAI. But their flagship open-source model just got overtaken by a Chinese competitor most people have never heard of. And xAI, merged into SpaceX, shipping a multi-agent architecture nobody else has tried, but still playing catch-up on every benchmark that matters. Look at that form line. On paper, everyone is growing, but the table doesn't tell you who's actually winning. The stats do. Player of the match goes to Anthropic, and it's not close. 1 billion in annualized revenue in December 2024, 4 billion by July 2025, 9 billion by the end of that year, 14 billion by mid-February 2026, 19 billion by early March. That's a 10x growth rate sustained for 3 consecutive years. No B2B software company has ever done that. Not Salesforce, not Snowflake, not Slack. The engine behind it is Claude Code, a coding tool that launched in May 2025, hit $1 billion in run rate revenue by November, sits above $2.5 billion today. More than half of all enterprise spending on Anthropic products goes through that single tool. And here's the stat that should worry every SaaS company watching. When Anthropic launched Cowork in January, basically Claude Code for non-developers, 4 engineers built it in 10 days. Most of the code was written by Claude Code itself. The software sector lost roughly $2 trillion in market cap in the weeks that followed. But the player of the match also picked up a red card. In March, the Pentagon designated Anthropic a supply chain risk to national security. The reason? Anthropic drew 2 lines: no autonomous weapons, no mass surveillance of Americans. The Pentagon wanted authorization for any lawful use. Those positions couldn't be reconciled. Within hours, OpenAI had the contract. Anthropic's CFO Krishna Rao called the enterprise demand incredible. He's right about the numbers, but losing the US military as a customer while your rival picks up the phone is not a clean sheet. And that's a momentum shift. 2 upsets on the board. The first is Meta. On paper, Meta should be dominating. They have the compute, they have the talent, including 20 researchers they hired directly from OpenAI. They have 2 new models in development, codenamed Mango and Avocado, with their chief AI officer calling Avocado the most ambitious language model they've ever attempted. So why are they on this side of the table? Last year, Meta released Llama 4 and immediately got caught gaming benchmarks. They submitted an experimental variant to the public leaderboard that performed better than the model people could actually download. It flopped. And while they were dealing with the fallout, a Chinese company called Alibaba quietly racked up over 1 billion downloads on their Qwen models and overtook Llama as the open-source default. Meta still has the resources to come back, but they're playing catch-up in a space they were supposed to own. The second upset is quieter, but it matters more. OpenAI. 900 million weekly users sounds like dominance. But look closer. In the US mobile market, OpenAI's daily share dropped from 69% to 45% in a single year. Google Gemini went from 5.7% to over 21%. The gap is closing fast. And then there's the ads decision. In January 2026, OpenAI started showing ads in ChatGPT. Cost per view, $60 per 1,000 impressions. Click-through rates below 1% in early tests. Anthropic responded with a Super Bowl campaign promising Claude would stay ad-free, called ads incongruous with personal AI conversations. On paper, OpenAI should be pulling away. The numbers tell a different story. They're growing, but the growth is decelerating. Revenue went from $6 billion to $25 billion in 14 months. That's extraordinary. But Anthropic did 1 to 19 in the same window. The pursuer is gaining. Let's go to the replay. 14 months ago, OpenAI had 6 times Anthropic's revenue. Today, it's less than 1.5 times. If current trajectories hold, the revenue crossover happens this summer. Here's where the scoreboard starts to crack. Every team on this table is injured. The same injury. None of them are making money. OpenAI is projected to lose $14 billion in 2026. Their total losses from 2023 through 2028 are expected to reach $44 billion. They spend roughly 75 cents of every dollar they earn on compute and talent. The gross margin is 33%. For a company valued at $850 billion, that margin would make a CFO at a grocery chain wince. Anthropic is burning $3 billion a year. They raised $30 billion in February to keep the lights on. The $30 billion raise at a $380 billion valuation means investors are betting this company will be worth more than Goldman Sachs before it ever turns a profit. And Google. Google is spending $185 billion on CapEx this year. That was roughly double what Wall Street expected. Analysts had modeled about $120 billion. The stock dropped 6% in after-hours trading when the number came out. For context, Alphabet's planned AI infrastructure spend this year is nearly half of its total 2025 revenue. Add it all up: Google, Meta, Microsoft, and the rest. The big tech hyperscalers are on pace to spend over $500 billion on AI infrastructure in a single year. $500 billion on a technology that hasn't produced a single profitable standalone company. And now the real test is coming. Both OpenAI and Anthropic are preparing for IPOs. OpenAI is targeting a filing in the second half of this year. Anthropic has hired Wilson Sonsini to advise. When they go public, they have to open the books. Every loss, every cost, every bet laid out in an S1 for the world to read. That's the second half nobody is ready for. So what does the second half look like? 3 things to watch. First, the price war. A Chinese company called DeepSeek is offering near-frontier AI performance at 28 cents per million tokens. Claude Opus charges $5. GPT-5 charges about $1.75. DeepSeek is 10 times cheaper. If their next model, V4, closes the quality gap further this summer, the pricing pressure on every Western AI company becomes severe. Second, the model race isn't slowing down. GPT-5 has finished pre-training. Claude Mythos has leaked. Gemini 3.1 Pro just took the top spot on most benchmarks. And Grok 4.2 shipped a multi-agent architecture where 4 AI agents debate each other before answering. The frontier is moving every few weeks now. Third, the IPO reckoning. Between OpenAI, Anthropic, and xAI, trillions of dollars in potential value are coming up for public judgment this year. But here's the thing about halftime reports. You're not watching this from the stands. If you work in software, your company is already paying one of these teams. If you write code, Claude Code or Copilot or Cursor is already in your workflow. If you run a business, you're already making infrastructure bets on which platform survives. And the uncomfortable truth about this race is that the team with the best product today might not be the team still standing in 2028, because this isn't a sprint, it's an endurance race. And endurance races aren't won by the fastest. They're won by whoever doesn't run out of money first. That's halftime. 5 teams, $500 billion on the table, 0 profits. We'll be back with the full-time report when the IPO numbers come in. Subscribe so you don't miss it.